Today I wanted to look at ticker symbol IBM and run it through my valuation spreadsheet. I wanted to run it through Graham's model, discounted cash flow model, and the dividend discount model. IBM is one of the long-standing companies, kind of in the background. They do a lot of business-to-business transactions. They don't do much consumer transactions. So this is a company that is pretty much silent and in the background that we don't see in the forefront very often. But over the past year here, we have seen it go up about 16%, and with a fairly decent dividend yield of 4.73%. I wanted to take a look at this company to see if it would be worthwhile investing. Now, over the past year, its performance, or at least its price performance, has been pretty dismal, pretty much gaining no value or losing 20% over the past 10 years, which is about a 2% decline every single year. With their most recent earnings report here coming a few months ago, so we should be expecting another one here in the next month or two, probably by the end of October or beginning of November. We'll do another IBM valuation video and see what we get. But just a few things to highlight here for this large standing company, highlighting that their overall revenue was down 0.4%, but two of their main revenue sources, software and consulting, were up 7% and 4%, where most of their miss was in their infrastructure. But taking a look at their cash flows, it does look like their cash flows are slightly up this quarter. Their year-to-date net cash flow from operating activities up $1.8 billion, and free cash flow up $0.1 billion. Taking a look at their segments, they operate in the software, consulting, infrastructure, and financing, and it looks like their biggest issue that's holding them back is in their infrastructure, which was down 14.6%. Their financing was up 26%, although it was only $0.2 billion in revenue, where these others are about a factor of 10 to 20 higher. Their software was up 7.2, and their consulting was up 4.3. So over on my valuation spreadsheet, I want to run it through the Graham's model. I'll show you where I got these numbers from: the discounted cash flow model, the dividend discount model. Click go, apply a margin of safety. I want to show you how I got that margin of safety, and then see if it is a buy or sell, and how much percent different if it's above or below the current stock price of IBM. And then I'll show you where to get these numbers from, so if you wanted to run your own valuation with your own margin of safety. We're also going to jump over to my compound interest analysis calculator. This is one of my more popular calculators. Simply taking inputs, you can compare two different inputs or two different ticker symbols or ETFs. We're just taking IBM today, put in the dividend yield and expense ratio if there is one, your monthly addition and your initial deposit at an annual growth rate, if you reinvest dividends or not, and we'll play around with this calculator and see what a portfolio and how much dividend yield we would get from IBM with the amount of IBM in our portfolio. But before we do that, let's take a look at Graham's model. Where are we getting this 4.8% growth rate, or 4.5% AAA corporate bond? Well, this right here is a quick Google. What is the current corporate bond rate? 4.5%, meaning if you put your money not in IBM, if you just bought a corporate bond, you would expect around 4.5%. Now the growth rate, coming over to Seeking Alpha under their earnings sub-tab, earnings estimates, at the end of December 2023, total earnings per share is estimated to be $9.57, which we put into our calculator, and the year-over-year growth of about 4.8%. So again, this is Seeking Alpha earnings and sub-tab earnings estimates. Now, if you don't have a paid subscription to Seeking Alpha, it definitely is worth the money. I do have a link in the description where you can get, they're currently running a 7-day free trial where you could just try it out for 7 days and see if it's something you'd like to invest in. Next up is the discounted cash flow model, and we're taking the 12 trailing months free cash flow and then the past 9 years of free cash flow, the full year. Perpetual growth rate, typically anywhere from 1.5 to about 2%. Discount rate at around 8%. Total cash and total debt. I'll show you where you get these numbers here, the free cash flow numbers and the total cash and total debt. These two, I always choose around 0.5 to about 2%. We'll choose 0.5 because it is one of them larger companies. I'll probably choose closer to a 2 or 3%, but if it's anything elsewise, I'll just choose 0.5% of perpetual growth rate. And discount rate, I'm always choosing about 8. So the free cash flow numbers, back over to Seeking Alpha. Under their financials and under their cash flow for IBM, their free cash flow per share, what I'm doing is taking from December 2014 all the way to the 12 trailing month figure right here and multiplying it by the total shares outstanding of each year. If we come up to the balance sheet and scroll down under supplemental items, we can see the total amount of shares outstanding. It does fluctuate year over year. So what I did was take the free cash flow number and multiply it by the total shares outstanding for each year to give me the total amount of free cash flow per year for that year. And then the total cash and the total debt. Over on the valuation tab for IBM, total debt $60.3 billion and $16.3 billion for the cash. That's where I got those numbers. Coming back over here, I wanted to show you what the free cash flow looks like growth-wise. Over here is just some data that is working behind the scenes. Under the discounted cash flow data, we'd have a total average growth of free cash flow at a negative number. So the discounted cash flow model is going to bring down the valuation of IBM pretty significantly. Just wanted to point that out there, that their free cash flow has not been very good. And then last but not least, the dividend discount model. Now IBM is paying a fairly decent dividend of about 4 to 5%, which is very high, very good for those dividend investors. So taking the numbers for our dividend discount model or the Gordon Growth model, all we need is the annual payout of $6.64 and a 5-year growth rate of 2.45%. Their dividend growth rate has been growing over the past 23 years. Taking a look at the dividend history, just want to give a visual of what their dividend payout has been. So it looks like they have been growing their dividend ever since about 1996, starting at 6 cents. A couple stock splits in there, and then it looks like they've been consistently growing their dividend over the past 23 years. Back over to the calculator, if we go ahead and click go, we can see that overall, with a 14% margin of safety, we are about 19% overvalued, sitting at $140, where our valuation is giving us, with a 14% margin of safety, $113. Without a margin of safety, we're looking at $131.99. Now the Grams model is giving us $169.37. That is with a 4.8% growth rate, and that's with that $9.57 earnings per share. The discounted cash flow model is still giving us $99.51 per share. That's with that negative 0.4% overall free cash flow growth over the past 10 years. Dividend discount model, I was expecting that to be a little bit higher with its fairly large dividend payout of 4 to 5%, but its 5-year dividend growth rate has been fairly slow. There are some stocks that we run through this calculator. The 5-year dividend growth rate actually breaks the calculation for the Gordon Growth model because it's growing faster than the market, which does throw some negative numbers in there. So you do have to play around with this when the 5-year dividend growth rate is unsustainable. Some stocks are growing at 10 to 15% their dividend growth, which is actually unsustainable over the long term. But IBM 2.25%, which gives us $127.08. Averaging all three of these together, $131. And then we come down to a margin of safety. This is just a simple guide that I put together. Now, if you are 0 to 5 years from retirement or 0 to 5 years from pulling from your portfolio, you want to be a little bit more conservative with your investments. So you want to apply a larger margin of safety, especially if you're investing in those micro caps or small caps. even your mega caps, you want to be a little bit more conservative. Coming to 6 to 10 years, 10 to 15, or 15 plus. Now, these are just estimates. Obviously, choose what you will for your margin of safety. For myself, I do believe this is a pretty decent estimation guide for how much years you are from retirement and the margin of safety that you can play. I would even say 15 plus years, you might even be able to knock this down another 5 points or so per market size cap. So with that being said, we are looking at IBM being slightly overvalued. Coming over to my compound interest calculator. Now this is a pretty fun calculator I put together. Just type in the ticker symbol and the historical growth rates appear here. So over the past 10 years, IBM has lost about 2.2% every year for the past 10 years. 5 years, it's about a minus 0.7. But the past 1 to 3 years, IBM has seen a slight tick upwards. It's price performance. If we click to the 1-year graph and the 5-year graph, we see that since about 2020, it has trended up in the upward direction, with it being a little bit choppy. Let's say we wanted to add $500 a month into IBM, and we would conservatively choose a 3% annual growth rate with reinvesting the dividends with no current money in IBM right now. After 10 years, if you had IBM in your portfolio at $500 a month with this growth rate and this current dividend yield, you'd be looking at around $90,000 in 10 years. And you'd be looking at pulling around $3,500 per year from IBM. And then this is what your IBM investment would look like after 10, 20, 30, and 40 years with dividends reinvested and with dividends not reinvested. And coming down here for IBM, if you wanted to pull $100 a month from IBM, you would need $25,000 worth of IBM. If you wanted $5,000 a month from IBM, you'd need $1.2 million worth of IBM. Same thing over here, $50,000 a year from just IBM, you'd need around $1.05 million. If you guys want access to this calculator and you want to play around with the valuation tab here, change your margin of safety, change some growth rate estimates, let's say in 2 to 3 months from now, when the new earnings report comes out, some of these values start to change a little bit. Maybe their dividend increases slightly. You can jump on the valuation tab, put in some new numbers, and check out what the new valuation would be. Head over to the Patreon page, download the calculator, and you can put in your own results. And with that, thanks for watching.